Okay, in the first video that I gave y'all, I covered the idea of bonds, but I did it without any present value applications. But I just tried to talk about it I talked about it at the 210 level. And if you have not watched that introduction yet, I would like you to go back and watch that, because in that one I emphasize the market-driven aspect of bond prices. Kind of looked at it as a supply-demand issue, which it is. But this time I'm picking a slightly different example, and we're going to apply the time value of money applications to it to specifically talk about how is the bond price calculated. So let me get me out of the way and I'll get into that. So in this one, we've got Needy Corporation going to the marketplace to issue $400,000 of bonds. And this time the rate that is stated in the contract is 8%. Now in the previous example, I used 9%. And so I'm going to work this one through and give you the solution. So what you may want to do is go back and just switch up the stated rate to 9%, go through the same procedures, and just see that you can fully calculate the price with the premium or discount and fully amortize it and so forth. And if you have any questions on that, please let me know. But on this one, remember, a bond is a stack of IOUs, and the face value of each one is $1,000. So we have a stack of 400 $1,000 bonds that we are issuing in the marketplace, but we're going to talk about it as one big transaction. So we're issuing this $400,000 bond. 8% is the rate that is stated in the contract. So remember that the bond is a contract, and when we talk about the stated rate versus the market rate, the stated rate, remember, where is it stated? Well, it's in the contract. Remember that the contract is written in concrete. So as we go through this, even though we may change up some of the market conditions, the contract does not change. When the investor, the person who purchases these bonds, and remember, don't let the lingo throw you off. This is a borrowing transaction. When the investor purchases these bonds, what they're doing is lending money to Needy Corporation, and Needy Corporation is giving them an IOU, and what that contract calls for is for a series of payments out there in the future. In this particular contract, it's a term bond, which means that the entire amount is due at the end of the term, $400,000, that's the maturity value. And every year we're going to pay 8% of that face value, which would be $32,000, as interest. So that would be the annual interest payments. That's what's in the contract. So anytime you're working a bond problem, or any problem for that matter, first thing you want to do is understand the contract. And I think it's very helpful to lay out a timeline and lay out the cash flows on that timeline. And remember, the cash flows are determined by the contract. So once you have that in place, as market conditions change, just remember that the contract doesn't. So in the first example, we're going to go to the market when the market rate is equal to the stated rate. So in that case, you know the bond is going to sell at par. So again, this is what we are issuing, a contract with these future cash flows. And you know that the proceeds is going to be $400,000 because the effective rate, market rate, same thing as effective rate, equals the stated rate. But the reason the proceeds are $400,000 is because we're going to present value these future cash flows using the effective market rate of interest. So here's the $32,000 is the annuity of interest payments. And we also have a lump sum of $400,000. We're going to present value that. With the N is 10 years, 10 periods, and the effective rate of interest is 8%. And when you present value that back, it brings you to a present value of $400,000. These table factors are rounded, and that's why the number doesn't come out exact there, but $400,000. Now these table factors are from the present value tables that I gave you in Canvas. So when we issue the bonds, we're going to record the cash that we get, $400,000. The bond payable is always credited for the amount that has to be paid when this thing matures. At the end of the first year, we're going to make an interest payment, $32,000. That's what's in the contract. Now let me analyze this journal entry here, the debit interest expense and the credit to cash. Here is what here's where this entry comes from. The credit to cash is equal to, that comes from the contract. It's the face value of the contract times the rate that is stated in the contract. That's the cash credit. Or if you were maybe accruing interest, that would be the credit to the payable. So the payable or the cash always comes from the contract. The debit to interest expense is an accounting issue. How much is the expense we should recognize this period? And it comes from the carrying value of the debt, in this case $400,000, times the effective rate, in this case 8%. So the interest rate and the cash equal each other, but they're calculated using different inputs. Okay, a couple of questions. What is the total? What are the total interest payments over the life of the bond? That'd be these credits to cash. $32,000 a year for 10 years. That's $320,000. And the total interest expense is going to be the $32,000 debit to interest expense times 10 years. So again, that's $320,000. Same answer, but different questions. At the end of every year, the amount reported on the balance sheet is the carrying value of the bond, which is the face value, the bond payable, plus or minus the discount or premium, which in this case is 0. Okay, now the way the interest expense and cash is calculated, I want you to hang on to that as we get into the next two examples. Okay, in the first one, we're going to issue this at a discount. The effective rate of interest, let me kind of move this just a little bit if I can. Okay, the effective rate of interest is 12% this time. Remember, the stated rate is 8%. We go to the market with a contract paying 8%, but the marketplace wants 12% for a contract of this nature. So the 8% doesn't look so good, so the price drops. Well, how far? Well, we're going to calculate that by using these future cash flows, the $32,000 annuity and the $400,000 lump sum, but we're going to present value them using the effective rate of 12%. So again, go to the tables, or you can go to your financial calculators, or you can use the present value functions in Excel. I'll talk about that in a minute. And anyway, the present value of these future cash flows discounted at the effective rate of 12% is $309,595. So that's our debit to cash. Remember, the bond payable is always credited for the face value that has to be paid back. And since we got less than face value, that's a discount. And we're going to debit the discount. That debit, remember, the discount is a contra liability. It's got debit balance. At the end of the first year, we're going to make an interest payment, and we're going to recognize interest expense. Credit cash for $32,000. That comes from the contract. Face value times stated rate. We're going to debit interest expense for $37,151. That comes from the carrying value of the debt. In this case, that would be the $400 minus the discount of $94.05. In other words, it'd be the $309,595. That's the beginning carrying value times the effective rate of 12%, and that gives us our interest expense. And then the difference between the two is the amount of the discount that you amortize. So that's the plug. So if you compare this to what we did in the first video where we were amortizing the discount straight line, and if you're using the straight line amortization, you calculate the amortization of the discount and the interest expense is the plug. When you're using the effective interest method of amortization, you calculate the interest expense and the amount of the discount to amortize is the plug. And remember that straight line method was okay as long as it's not significantly different from this method, but this method is really the one that GAAP prefers. So when we amortize the discount, that leaves a remaining discount of $85,254. So now if you'll notice, the carrying value at the end of the first year, let me kind of recalculate that. It's now equal to the 400 minus the remaining discount. So the carrying value has gone up by the amount of the discount that we amortized. And now in the second year, the interest expense is that new carrying value times the 12%. The cash, of course, comes from the contract, and so we have a slightly different amount of the discount to amortize in the second year. So at the end of the second year, after that second amortization, the discount's a little bit smaller, and so now the new carrying value at the end of the third year is 400 minus that remaining discount. So if you notice, the carrying value is slowly going up over time, and by the time that discount is fully amortized, the carrying value will equal the maturity value, and of course that's what we're going to pay when this thing matures. Another way to look at it is the carrying value is equal to the remaining present value. You might want to test that out, but the carrying value is the present value of the remaining future cash flows discounted at that original effective rate. Okay, let's look at a couple of questions here. What will the total interest payments add up to over the 10-year period? $320,000. What will the total interest expense be? Well, it's going to be that $320,000 plus or minus the discount or premium. In this case, we're going to add the discount because the discount represents additional interest, as we talked about in the first video. So again, we're getting $309,595 at the beginning, but we have to pay back $400 when this thing matures. That discount is additional interest in addition to that $32,000 a year. Okay, so prove all that out in your calculations. Let's look at the third example. This time, the effective rate is 6%. So the rate has come down, and now this thing is going to sell at a premium. Remember, when the rates come down, bond prices go up. When the rates come down, bond prices go up. The full song is this. When the rates come down, bond prices go up. When the rates come down, bond prices go up. When the rates come down, bond prices go up. And the bonds will sell at a premium. Kind of corny, I know, but when you're trying to remember things, the cornier you make it, the easier it is to remember. So there's this inverse relationship between interest rates and bond prices. So I calculated the present value using the 6% effective rate to be $458,879. So we're going to debit cash for that. Always credit the bond payable for the amount that has to be paid. And in this case, we're going to credit the premium for the difference. So again, the premium is not a contra liability since it adds to, but it's a valuation account. It adjusts the carrying value of this bond. At the end of the first year, we're going to make a $32,000 payment. That comes from the contract, face value times stated rate. We're going to debit interest expense. That comes from the carrying value times the effective rate. That carrying value consists of the face of the bond payable plus the premium, and we're going to multiply by the effective rate of 6%. And so the difference is the amount of the premium to amortize. And so that premium is coming down. Remember, the premium had a credit balance, so to amortize it requires a debit. And so now the remaining carrying value is equal to that 400 face value plus the remaining premium. And so you'll see that the carrying value is gradually coming down. In the second year, the interest expense will be equal to that new carrying value, the carrying value at the beginning of that period, times the effective rate. The $32,000 credit to cash comes from the contract. And in the second year, we're going to amortize a little bit more. Remember, the carrying value is coming down, so the interest expense is a little bit less each time. Okay, so we're going to amortize just a little bit more on that premium. At the end of that second year, the new carrying value is the 400 plus the remaining premium. So again, you can see that the carrying value is gradually coming down. That carrying value is what is reported on the balance sheet at the end of each year. And remember, that is the present value of the remaining contract, discounted at that original effective rate of interest, the rate that was effective when the bonds were issued. So in total, I think it's good to remember, in total, what is the effect of that premium or discount? Total payments are going to be $320,000, but the expense over the life of the bond is the $320 minus that premium. That's the total expense. Remember, They gave us $458 at the beginning, but we only have to pay back $400. That 58 is offsetting that true cost of interest. Okay, so that's the overall accounting of it. Let me look at the amortization schedules for each of these. That word amortize means to make it gradually disappear. So at the beginning of any contract, any lending contract, an amortization schedule will be prepared, and that really provides the inputs to all of these journal entries that we've been making. So it's like when if you get a car loan, at the beginning of that loan, they will give you an amortization schedule, and it'll show how each payment whittles away that car note. Well, in this case, here's our amortization schedule. And let me kind of adjust this just a little bit. That's not what I want to do. Okay, so in an amortization schedule, you're going to have the face value of the payable plus or minus any premium. In the first one, it's zero. So that's your book value or carrying value. Your interest expense is equal to the carrying value times the effective rate. The payment is equal to the face value times the stated rate. And so in the first case, we had no discount or premium. And when you add them all up, the total expense equals the total of the payments. In the second case, we had a discount, which reduced the book value, and the expense is equal to the book value times the effective rate each period. All the way down is the book value at the beginning of that period times the effective rate, and the interest payment, of course, is equal to the face value of the contract times the rate that's stated in the contract, the stated rate. And then here's the same thing for the premium. I want you to notice that in the exam, I may ask you to do an amortization table, and what you total, these totals help to show that everything is coming out okay. These columns are not totaled because those are not meaningful totals. But one thing you want to double check is when everything is said and done, did you fully amortize the discount or premium that you started with? And so if you've prepared the amortization table correctly, then it'll be fully amortized. And in this case, there's a little bit of a rounding error, and that's because my original discount was rounded from those table factors. And so what you would do in that final year, just make sure you plug in the difference and fully amortize the discount. Also want to mention that on Excel, the present value functions are there. Let's see if I can adjust this. So you'll see that when I was present valuing the annuity, you can do that with the NPV function. That stands for net present value, but it actually is only a present value of an annuity future payments. There's no original outlay that's netted there. And if you have a lump sum amount, like we do for the face value, that would be using the PV function. So you may want to experiment with that, and I'll take questions if you have any. But anyway, that's dealing with a bond payable using the effective interest method of amortization and how you calculate the present values. So the key thing is, at the very beginning, understand the contract, lay out the cash flows. And when you see that, you'll realize that's how every contract is handled, whether it be a bond or a note, a mortgage on a house, or as we're going to be talking about next week is leases. The only difference is with a lease, you lay out the contract, you understand what the contract is, and then you present value it. And so the application has a lot of similarities. Okay, have fun with that. See you later.